Good afternoon. This is Harold Moan from UHY Advisors. I want to thank everybody for joining our webinar today. We are going to discuss some kind of current issues and planning ideas for succession planning during the coronavirus pandemic. So we'll go ahead and get started. We'll kind of go through some of our information today, and then at the end we'll have time for questions and answers. So if you have questions, I believe you can enter them through the chat or the ask a question button on the webinar system. So today we have myself. I'm Harold Moan. I'm with UHY Advisors. I'm the Regional Managing Director for the Mid-Atlantic region. We also have JT Frykowski of Merrill Lynch, Wealth Management Advisor, James Brennan from Bank of America, a trust specialist, and John Bautista, who's also a Managing Director with me at UHY Advisors. So we will take some time to kind of walk through today a few things. I'll give you a little bit of information about UHY. JT will give you a little bit of information about Merrill Lynch, and then we'll kind of talk about the current kind of tax environment that we're in, and then go through some kind of specific questions that we'll try to answer and talk about some options for administering the trust administration, some things like that, and then we will get to questions and answers at the end. And I hope everybody gets some important information out of this. UHY, we're a national office. I'm a national accounting firm with 21 offices across the country. We do all types of CPA services, audit and assurance, tax, consulting, advisory. We have John here with us today, who is the head of our valuation practice. So we've got some great experts here today. And JT, do you want to say a few things about Merrill Lynch and Bank of America?
Yes, sir. Thanks, Harold, for hosting us. I'm sure Merrill Lynch is a brand name that a lot of the folks on the call can recognize. But just a reminder, Merrill Lynch is a global wealth and investment advisory firm, and we are a wholly owned subsidiary of Bank of America. So through the Maryland-based advisory team I'm referencing is my group, concentrating on private business owners and also corporate executives of publicly traded companies. And really what we deliver through the Merrill Lynch platform is financial planning across your entire net worth, to include business ownership, liquid assets, retirement plans, lending, as well as estate strategies and trust implementation. And that's where my team member and specialist, James Brennan, comes into play, is helping us with those types of strategies. We do provide investment management, lending and banking solutions, and to kind of wrap it all up, family CFO level relationship where we help you make just strong decisions across everything financial in your life.
Thanks, JT.
You got it.
So kind of the idea for this kind of webinar came out of some conversations JT and I've had, some conversations that I've had with a number of clients as far as conceptually taking advantage of the current tax laws, just because we don't know where things are going, right? So I feel like on different days of the week, some days you think that maybe we'll continue with the current tax system, and there's a real possibility that there'll be a change in administration come November. And it's important to kind of know where that administration's thought processes are when it comes to tax issues. And just, you probably can't read the screen that you have up there. It's kind of some small type, but one thing to kind of keep in mind when they're talking about the current tax brackets, the maximum rate right now is 30 7%, and Mr. Biden is talking about taking it up to 40%. He's also talking about changing the long-term capital gains, doing away with the current system as far as the 20% cap gains rate for certain people, talking about, again, going back to what we used to have as far as itemized deductions, limiting the ability to deduct those items. They're talking about eliminating the step up in basis when items pass through an estate. They're talking about changing the current cap on your Social Security tax on your wages, and taking it up from about 137 now to even more. So it's an ever-changing system, I think, is what's going to happen. They're talking about rolling back the corporate tax rate adjustments that took place at the end of 17. So there are all these things going on, but currently, I think that's what makes it important to determine what you can do now in order to take advantage of what we know the tax laws are now when it comes to estates and those types of things. So with that, I will turn it over to one of my partners here at UHY, John Batista, and let him kind of talk through some of the items he has to talk about today.
Thanks, Harold. So I guess the key things that we want to consider here is when it comes to succession planning in the current market environment is, number one, is how has the current market affected the value placed on your company? And added to that, we'll tie in what Harold was talking about in terms of the uncertainty in the tax legislation. So some of the key considerations that are impacting company value. First one is pretty obvious. There's uncertainty on economic recovery. As you may have been listening to news as well, just the decisions on monetary and fiscal stimulus, there's debates as to what's the most optimal thing to do. So there's just a lot of uncertainty in the economic environment. As you can anticipate, that poses more risk, so there's a tendency to lower values from that. Secondly, what is the willingness of buyers and sellers to transact in a suppressed environment? What we've actually been seeing is M&A firms and private equity firms have been putting deals on hold or their M&A activity on hold, and at times have actually even canceling out on certain M&A deals that were actually in place. So that again is actually going towards more of a situation where it's bringing values down in terms of what would transact out in the marketplace. Third item is when you look at your company as a private company versus the public companies, you may be seeing market rallies where the market price volatility is going all over the place, and even as currently been coming close to all-time highs on the indexes, when in fact we see the economic recovery anticipated for years, potentially years down the road. So what does that mean? To the extent that we're talking about private companies versus public companies, private companies are less so prone to the volatility and the market rallies. And they're much more stable, and especially these upswings that you see in the markets aren't things that you would necessarily expect in the private companies and how the private companies would transact. Next thing to also consider is industry. Now, as you know, during this in this current environment, some companies, some industries have actually benefited from the current state of the environment, such as the healthcare industry. And then conversely, there's a lot of other industries that have been adversely affected, such as the restaurant industry and the travel industry. Further to that point about what's transacting in the market these days, those companies that have been positively affected, such as healthcare, are the ones that have the stronger valuations. Those are the ones that are actually still transacting in the market. The last point that I wanted to bring up is that more so in today's environment versus what we're seeing in the past, not only is it's important to understand where you are, which industry you're in, but there are you're more dependent on your company specific factors. Even in the similar industry, the same industry, we're seeing valuations and the dynamics associated with the specific company risk factors that makes your company potentially not comparable to others within that industry. So, you know, to the extent that some are hit favorably or unfavorably, your situation could be not fully correlated to what we're seeing in terms of that market pricing. So some of those trends, we'll bring it back. We're still on that the first slide. So in terms of those company-specific risk factors, there is less reliance on your historical trends, and there's much more focus on the forward cash flows. As some of you may know, the value of your business is really predicated on what the future cash flow generating ability is of your business. So historically, you've been able to look at historicals as an indication of those future cash flows, but it's definitely not the case in today's environment. Especially in situations where we're talking about uncertainty with recovery and the timing of that, if in fact there is a recovery for your business, and especially small and middle market companies, as you probably know, you're at a higher risk for survival than some of the bigger public companies. The uncertainty of the current situation has definitely elevated the risk in a return profile, and it's uncertain in some instances whether that is temporary or that is a permanent situation that impacts your company specifically. So what we're seeing these days is in valuing these companies, there's a lot more scenario analyses put in place to actually try to understand the different alternative scenarios that this could take your business. And additionally, on what we're seeing from the key benchmarking agencies that put out market returns, risk and return, some of them are actually placing an extra 1% risk return increase. And as if you know what that does to values, it actually brings values down, given all these uncertainties in the marketplace. So at the end of the day, what we're talking about is, you know, whether you've been positively affected by the current environment or negatively impacted, in all instances, or the majority of this is pointing to lower valuations. Now, so what does that mean for us going forward? Jen, you could change to the next slide. So how does the reduction in value of my company impact my estate planning? Well, as we just discussed, majority of the situations, we're talking about lower valuations today, whether you're expecting a recovery or not, and when that is going to happen. These low valuations put us in the prime time to actually take action for your succession planning. Coupled with that is the tax environment. As we were mentioning, depending on the current upcoming election and the current the upcoming tax legislation, things could change in the tax situation, which reduce the opportunity for you to benefit from the current tax legislation. The biggest one is, turn to the next slide, Jen. Is when we're talking about the current estate tax exemption. Currently, as you can see from this chart, each individual has approximately 11.4 million in terms of the current estate tax exemption that, based on the current political environment and uncertainty surrounding tax legislation, that is actually expected to sunset in 2026. But if things change around, that could actually go away sooner than later. So what does that mean? It means that, to the extent that you want to make any transfers, whether it's gifting or putting things into an estate, if that 11 million, let's say, goes down to the 6.5 million that we're talking about here, is you have less protection for being tax exempt for those transfers that you do. So again, given the current environment, low valuations, the current estate tax exemptions, with proper structured current gifts to family members and movements to trusts that take into account these lower valuations and the current tax legislation, families can pass a greater share of their business to their heirs tax-free. So I'll move over to James.
Great. Thanks a lot, John. I appreciate it. Can you hear me okay?
Yes.
Excellent. So just to segue as far as the implementation goes, to kind of walk you through how we effectuate some of these transactions, to give individuals on the line background, Bank of America acquired U.S. Trust from Charles Schwab in 2007. And they pretty much did away with the U.S. Trust Company name and absorbed the trust company into Bank of America, with the exception of our Delaware Trust Company. So we still have U.S. Trust Company of Delaware, chartered in Delaware. And when we talk about these transactions, many of these assignments or transfers occur within our Delaware Trust Company. And that begs the question, why are they housed there? Most traditional trust company statutes that vary by state really have the fiduciary duty of liquidity and diversification, where private stock in entities such as LLCs can amount to concentrations. And if I have the duty both to administer a trust and for financial oversight and governance on the trust, I often don't want to hold, let's say, a 50% interest in an LLC in a trust. Well, when we're an administrative trustee in Delaware, we can outsource the financial oversight to an investment advisor or an investment committee. So we can bifurcate those fiduciary duties. What does that mean for these types of transactions? We house a lot of illiquid assets like commercial real estate and potentially business interests like shares of LLCs, or pieces of real estate investments like limited partnership interests. And when we house those illiquid investments in Delaware, typically we charge a fee, and it's a hard dollar fee for that period. How do people typically effectuate those transfers? Usually individuals set up, say, a dynasty trust. And why are people attracted to Delaware? As you all know on the phone, Delaware has no state level taxation. It also has no rule against the perpetuities. It has a body of case law that protects you against potential creditors. So therefore, Delaware is a very attractive situs for your trust. And so even though you might live in a different jurisdiction like California or Virginia or Maryland or New York, you can have your trust administered in Delaware because your trust company that you're working with is housed there. And your nexus to Delaware is the fact that your trust company is based there. So that's why we have a Delaware charter. And so when we look at how these transactions are implemented, we typically assign an LLC or a portion of an LLC to a dynasty trust or a GRAT. And, if I were to think about the political landscape, if Vice President Biden is elected and your exemption comes down, that would only cause you to consider something like a GRAT even more so, because you'd be so conscious of any piece of your estate exemption or your coupon, as they say, that you're utilizing, that it's even more fragile, and you'd want to be even more careful with what portion of your coupon you're using. So as you know on the phone, that if you use a GRAT to potentially transfer a $2 million interest in a business and you potentially claw that back into your own estate, all the growth after we get out of this and the economy recovers and your interest goes to $5 million, that $3 million of appreciation is outside your estate, and that could pour into a dynasty trust. So we see most of these transactions occur in conjunction with our trust company in Delaware, and either utilizing a dynasty/family trust or a GRAT. So that's just my personal experience working with the trust company, but I do see individuals focusing on this as a strategy as they would say comps or comparables are down in marketplaces. We just did one of these transactions for a steakhouse owner in Florida. It was still a $100 million company, but the industry is beat up and his particular revenues are down 60%, but he's going to live to fight another day. So he's trying to make lemonade out of lemons. So that's pretty much all I have. If you want to follow up directly, please follow up through JT Forkowski, and he can book a time for us to speak further on the implementation.
Okay. Harold, am I up?
You're up, JT.
Okay. So, everyone, thanks for listening in. I battled on what to call this slide. We came to practical considerations, just trying to get to the meat of it, of the, what's in it for you, right? Why are you taking this time to listen to a couple of gentlemen wearing blazers at home? So, I think the why, I want to really hammer that home. Jen, if you don't mind, can you go back to the bar chart real quick, and then we'll flip back. Thank you. So just to kind of really hammer this home, this illustration, I'm going to use in 2019, let's use a $15 million business valuation. Okay. Let's say today, given what John said about valuation, let's just say, for example, your valuation on your company has gone from 15 million down to 10 million on paper, right? Due to how John can value the company. Let's just say, for example. So if you look in this bucket on the left, it's 11.4 million exemption. What that means is that you can give away, not that you're going to, you can give away that much to trust, as James was referring to, and get that out of your estate. And what we're saying is, because businesses values are compressed, and arguably, if you believe your business is going to go back up in value as the economy recovers and earnings and revenue go back up, okay, and volatility subsides and M&A transactions, so the value could go back up to 15 million. And then what we're saying is the amount you may be able to give to your heirs tax-free is set to go down in 2026. So that gap of potential taxable wealth of your business is potentially going to increase from today, right? Due to growth of the business, as well as a decreasing exemption amount or an increasing taxable estate. Okay. So the strategy that James is referring to about a GRAT is really just saying, hey, let's take a portion. Jen, if you go back to my slides under practical consideration again, and that's the last time I'll ask that. Thank you. So my key question is, James is talking about a $100 million business. I'm talking about a $15 million business. And I would argue that most of you on this call that own a business or advise people that own businesses, right? The majority or all of your net worth may be tied up in your business. And we are not recommending that you give away your business. What we're recommending is you think about this as it relates to your estate, because you may be at a crossroads where the valuations have come down and the taxable exemption is still at a high point where it may make sense to exercise this this idea where you can get the appreciation of a discounted value. Say it's a $15 million business, come down to 10, but with an economic recovery and time, you may have a $25 or a $30 million business when you pass. Okay. And what we're saying is we're offering a unique time. It's a unique point in time where you may be able to say, take $2 million or 20% of this business, 10% of the business, whatever we end up figuring out makes sense for you financially. Retitle it into a trust vehicle. And then the growth of that asset can then be out of your estate for forever and gifted to the next generation, heirs, grandchildren, children, grandchildren, whatever, charity, however you choose to get that, or however you choose to give that. And we could figure out how much you need to live off, right? And make sure that we are not doing anything that would jeopardize your personal, finances if and when you were to sell the company or phase out of the company altogether. But the point is that there's a great opportunity here to get a lot of the appreciation, the future appreciation, out of your estate. And the importance of that is that state taxes, depending on your jurisdiction, can be as high as 50% over and above those estate tax exemptions. Right? So imagine over that estate tax exemption, if that goes back down to $6.5 million per person. So now you're talking about 2 spouses own a business. Now you're talking about a $13 million exemption. Every dollar that your estate is over that $13 million could potentially be taxed and cut in half. So that's what we're talking about. That's the urgency. That's the thought process to, hey, let's try to get this appreciation down to the next generation so that we can avoid that. Very simply, just how do I explore if this is right for your business, for your family, for you? Just give Harold or me a call or an email. So Harold is the regional director of UHY tax, advisors. They provide tax, audit, and then the valuation support. And now I come in from the financial planning and certainly the estate strategy side. Okay, we would work hand in hand with an estate attorney to draft proper documents. But this is not a pitch whatsoever. I'm just saying, hey, if you want to explore this idea, reach out to Harold or myself, and we can at least figure out, based on some cursory conversations, if it's something we should go down that path with you. Okay, that's all I have. I don't know if Harold, did you want to close up?
Yeah, sure. Thanks, JT and James and John. A lot of good information. I think one of the things that James had mentioned it earlier, of making lemonade out of lemons, is, we're in a very unusual time with the pandemic, and it has created at least one, I think, planning opportunity for those that are kind of paying attention in order to try to maximize that exemption amount and that benefit to your family. If I don't see any questions in the chat, Jen, do you have any questions in the question section? I'm not sure if they show up in the chat or not.
No, I haven't seen any.
Okay.
Oh, wait, there is one question, and the question, can this be done even if you are an S Corp?
Yes, it can be done if you're an S Corp. It depends, you got to take that into account, but there are ways to, whether you're giving it to the next generation, or there are ways to make sure that it does not get rid of the S election. So there are ways to do that.
Don't we, just to interject, Harold, and then James too, don't we usually see this done with LLC interests?
It could be done with any. I mean, I've had some clients that have done it with a C corporation in order to get the any increase in value of the C corp into a trust for the next generation. So it can be. I think you can do these. You have to structure it a little differently, but you can do the same thing with whatever type of entity it is.
Yeah, and that's my experience as well. You know, with the S election, just because you're limited to warm bodies as members of the S, so sometimes you know you have additional planning that the trust itself might void the S election. So that comes a lot up with charitable trust funding, and
yeah.
But so it's just an additional level of scrutiny that and structuring that we have to apply.
Correct. Yep. Anything else in there, Jen?
That's it.
Okay. Well, listen, we want to thank everybody for attending today. We'll let everyone kind of get back to their Monday. There'll be a copy of the presentation available, and there'll be, I think it was kind of recorded, so those will also be available. If you have any questions, reach out to any of us. Shoot us an email. We'll be happy to follow up with you and make sure that you get all your questions answered. So once again, I want to thank our panelists, John, James, JT. I want to thank everyone for being here today and taking the time, and we look forward to doing something again in the future.
Thank you, Harold.
Thanks, Harold.